Welcome students, welcome to lecture number 27, where we will be seeing module 4, income from capital gains under subject direct taxation. So as we know that in this particular module, as per VTU syllabus, it covers this different types of elements in which we are still continuing with computation of capital gains. And today again, we will be continuing the same. So today we will be seeing computation of capital gains. As we know, capital gain is a gain arising from transfer of a capital asset, and short-term capital gain arises when you transfer a short-term capital asset, and a long-term capital gain arises when you transfer a long-term capital asset. How do you identify whether a particular asset, capital asset, is short-term or long-term? Depends on the period of holding. Next, we know cost inflation index. This is very important index in order to solve problems relating to long-term capital assets. In our previous class, we were continuing with notional sales consideration. So we had seen notional sales consideration means where you have to consider the sale consideration as a notional sales value and not the actual sales value. So there were different cases where we have already seen two cases. That is in case of insurance claim, what is going to be the sales consideration, whatever compensation the SSC is receiving from the insurance company, that is going to be the sales consideration. And in case of conversion of capital assets into stock in trade, it is going to be sales consideration is going to be the fair market value of the asset on the date of conversion. The date you are converting the asset into your stock in trade, that is the date, fair market value, whatever is the fair market value as on that date, that will be your sales consideration. Then these are the different elements that we are now supposed to see. So first, let us understand insurance claim received. Whenever you're receiving any...
Yes? Hello, ma'am. Sorry for the disturbance. Yashashwini is waiting, ma'am.
Okay. She's not entered the room. Would you just tell her to enter the room?
Okay, ma'am.
Okay, so in the last class, we had already seen about insurance claim received. So this is just a quick revision of that. So in case a problem arises where an SSC's asset is being destroyed, okay, destroyed by different reasons that we have seen, then obviously insurance company will give some compensation. So that also is treated as a transfer. And how do you compute capital gains in that case? So sales consideration, what are you supposed to take? If compensation is received in cash, suppose the insurance company is giving you cash as the compensation, then compensation, whatever you're receiving in cash, will be your sales consideration. If compensation is received in kind, suppose a particular building is being destroyed, and in return of the building they are giving you building itself, they're not giving you cash, but they're giving you the compensation in kind. So it will be fair market value of whatever asset they're giving in kind, received as compensation, will be your sales consideration. Cost of acquisition, cost of improvement, expenses on transfer will be as usual that we have seen in so many different problems. Whatever you consider it the same. Indexation benefit will be available only up to the year of destruction. So indexation benefit will be available only up to the year in which the destruction has taken place. So when you take CII, when you take the index, you have to take the index only up to the year of destruction. So you have to see which is the year of destruction. Take this cost inflation index of that particular year. And which year is this taxable? Is it taxable in the year in which your asset is destroyed, or is it taxable in the year when you're receiving the compensation? Remember, students, you have to tax this in the year when you're receiving the compensation. And tax rate, whatever tax rate is applicable in that particular year, you have to use that particular tax rate. Now, what we will do is we will see each such scenario. Simultaneously, we will see problems relating to this scenario so that you understand this particular slide nicely. So let us see a problem on this. So problem in case of insurance claim. So now you'll know there are only 4 elements that while solving any problem on capital gains. First, we need to know what is sales consideration, what are the expenses on transfer, what is the index cost of acquisition, what is the index cost of improvement. Once we know these 4 elements, identify these 4 elements in the problem, we can easily solve the problem. Now, in case of insurance claim, I have already explained now in this particular slide that in case of insurance claim, what is going to be the sales consideration, what is going to be the cost of acquisition, cost of improvement, and cost expenses on transfer is already being explained. Okay, so let us go to the problem. Okay, students, let me read the problem. Lucky has a house property acquired on 18/8/2019 for 6,000. So can anyone tell me what is this term to be used in the computation? What is this term? Quick, students. I want a quick answer. Cost of acquisition. Very good. Now he used the house for his own residential purpose. Now, on 18/8/2012, he incurred capital expenditure on reconstruction of the house, 3 lakh. Now, can anyone tell me which is this term? Improvement. Very good. Next. So, we got 2 terms, and as per our provision that we have seen, in case of insurance claim, your cost of improvement and cost of acquisition is going to be as usual. So, okay, we are going to take the same as usual, nothing changed to be done. Next, on 15/5/2019, he brought office goods. Now, office goods are nothing but your stock, because they are office goods, and goods are nothing but stock. Inflammable worth rupees 1 lakh at home to be delivered to a party staying near to his home. So he got 1 lakh worth rupees stock at his place because he wanted to deliver to a particular customer who was staying near to his house. At the night of the day, accidental fire took place and damaged the whole house property. Whole house property was damaged. Furniture worth rupees 5 lakh was damaged, and business stock worth rupees 1 lakh. Here he had got a business stock of 1 lakh, that also was damaged. So now the destruction took place when? The destruction took place on 15/5/2019. Now, insurance claim was received on 18/8/2019. So 15 May destruction took place. 18th August insurance claim was received. Now let us see what is the claim received. For house, 1 lakh was received in cash. Now we know that the entire house also was being damaged. So for house, how much insurance claim did he receive? 1 lakh in cash he received, and the new house property was allocated to him, the fair market value of which was 44 lakhs as on 18/8/2019. Okay. Now, for household furniture, he received 2 lakh as cash, and for stock, he received 80,000 as compensation from insurance company. Now, tax treatment, show the tax treatment under the head capital gains, and how will your answer differ if the compensation was received on 15/4/2020? So, students, first of all, let us identify, okay, what is the asset that is going to be chargeable to tax under capital gains. Now, tell me students, household furniture, is it a capital asset? Household furniture, students, is it a capital asset? It is not a capital asset, because in the definition of capital asset, we say that capital asset means any kind of property held by the SSE, but does not include, in exclusions we have seen, it does not include personal effects. Movable personal effect has been excluded. So this is household furniture is personal, furniture is movable. Therefore, 2 lakh rupees is not going to be chargeable under capital gain. Therefore, this is excluded. Now, stock. Students, tell me, stock will be, is it a capital asset? Or is it a business item? Is it an item related to your business or profession? Students, I want it to be very good. It is an item relating to your business or profession. So whatever compensation you're receiving on furniture and stock will not be liable to tax under the head capital gains. I hope you'll have understood the reason why. Next, let us see house. Now, as in house, when it's getting destroyed and though it is for a personal use, will it be treated as a capital asset? Yes, because house is an immovable property. Though it is having a personal effect, it is an immovable property. In the exclusions of capital asset, we have only movable property, which is personal, is excluded, but not the immovable property. Now, let us start solving the problem. Now, in our insurance claim, we said that what is the sales consideration you're supposed to take? If you're receiving in cash, the compensation in cash. If in kind, fair market value of asset received as compensation. Okay. So see, sale consideration of house. Okay. How much is the value you're going to take? 1 lakh you're receiving in cash, and in kind you're receiving 44 lakhs, because if you're receiving in kind, you have to take the fair market value always. So 1 lakh plus 44 lakhs becomes 45 lakhs. So sale consideration of the house is 45 lakhs. Students, did you all understand this? Yes, students?
Yes, ma'am.
Okay, less expenses on transfer. There are no expenses on transfer, therefore it is nil. So net sale consideration is 45 lakhs, less indexed cost of acquisition. Why we are taking indexed cost of acquisition? Because it is a long-term capital asset. It was purchased in the year 2009, but it was destroyed in the year 2019. Therefore, it is a long-term capital asset. So we have taken index cost of acquisition. And in this particular provision of insurance claim, we have seen that index cost of acquisition and index cost of improvement will be as usual. Means normally how we do the same thing. So what is the index cost of acquisition? How do you calculate index cost of acquisition? You take the cost of acquisition into CII of the year of destruction divided by CII of the year of acquisition. Okay, here, because we have seen here that the indexation benefit is available only till the year of destruction. So let us see, 6 lakh rupees we have taken because the Lucky had acquired the house property in on 2009 for 6 lakh. 6 lakh we have taken. Now what is the year of destruction? 2019. What is the CII for 2019? If you check 1920, it is 289 divided by 148. If you see the CII for the year 2009-10, it is 148. 2009 and 10 students here, it is 148. So you have taken 148. So when you calculate this, you get 11,71,622. Next. So this is index cost of acquisition, understood by all?
Yes, ma'am.
Okay, now index cost of improvement, you all said that 3 lakh is nothing but cost of improvement. How do you calculate index cost of improvement? Simple, cost of improvement into CII of the year of destruction divided by CII of the year of improvement. What is the year of improvement? 2012. So 2012, if you see, the index is 200. So you have taken here 200. You have to just solve this particular equation. You get it, and when you total this, you get it at 16,05,122. When you deduct the net sale consideration from index cost of acquisition, index cost of improvement, you get the long-term capital gain, which is nothing but 28,94,878. In the notes, you can write, for furniture, no capital gain liability arises as furniture is a personal asset of the SSE and hence it is not a capital asset. And if it is not a capital asset, obviously it will not be chargeable to tax under the head capital gains. Compensation received on loss of furniture shall be treated as a capital receipt and hence not liable to tax. Next, stock. Students, what was the cost of stock? 1 lakh. But how much insurance company is paying the compensation for stock? 80,000. So is it a business loss or business profit? Will you show it as a loss in your head, business profits and gains from business or profession, or will you show it as a profit?
Loss.
So there's a loss of how much? 20,000. So see here, compensation received on loss of stock shall be liable to tax under section 28. That is nothing but under the head profits and gains from business or profession. In the given case, there is a loss of 20,000 because 1 lakh minus 80,000 shall be allowed under that particular head. Now, there was one more question attached to that. How shall your answer differ if such compensation is received by the SSE on 15/4/2020? That is the next year. Okay, it is received in the next year, then obviously it will be chargeable to tax in the assessment year 2021-2022. So your answer will be, in such case, the compensation is received on 15/4/2020, then the capital gain as computed above shall be taxable in the assessment year 2021-2022. 22. Is this clear, students? Is this sum clear? So whenever you have getting problems on any such provision, so if you just go through the provision, everything has been already given here, that what is the sales consideration you're supposed to take, what is the cost of acquisition, what is the indexation up to which year it will be available, and when it will be taxable. Okay, it will be taxable in the receipt of compensation. Suppose you're receiving compensation next year, it will be taxable in the next year, not in the current year. So did everyone understand insurance claim? If yes, we shall move ahead to the next type of transfer, okay, which amounts to transfer, that is capital gain on conversion of capital asset into stock in trade. In the definition of transfer, we have seen that when any capital asset is converted into stock in trade, it is regarded as a transfer. Now, if it is regarded as a transfer, obviously there is going to be a capital gain. So let us see. From assessment year 1985 to 1986 onwards, conversion of capital asset into stock in trade shall be treated as transfer. Means if any capital asset is converted into stock before 1985-1986, then you're not going to calculate the capital gain, because that time it was not regarded as transfer. It started being treated as transfer only from the assessment year 85-86. So remember, if in the problem you are getting that any conversion has taken place, suppose in 1980-81, then you please don't calculate capital gains because it was not regarded as transfer. Now, what we have to do in this situation, let us see. So as I already explained in my previous session, that whenever any capital asset is being converted into stock in trade, there are two types of incomes that are being generated. One is income from head capital gains. One is income from head business or profession. Why business or profession? Because the stock word is involved. Okay. So income from head capital gains, we know that there are different types of terms that are involved. What are the terms? Sale consideration, cost of improvement, cost of acquisition, and expenditure on transfer. Now, what is the sale consideration you're going to take in such a scenario? Take the fair market value as on the date of conversion. When the date you're converting, what is the fair market value? That will be your sale consideration. In case of cost of acquisition, cost of improvement and expenditure on transfer, it is going to be as usual. As usual means normally whatever we follow, it is going to be that. Next, indexation benefit will be available only up to the year of conversion, not up to the year that you're selling the stock. It is going to be available only till the year of conversion. Means the year that you're converting the capital asset into stock in trade, up to that year. It is taxable. Now, which year it is taxable? In the year in which the stock is actually sold. Students, you may convert in the year 2016, but the stock may be sold in 2020. So it will, capital gain will arise in 2016, but taxability, it will be charged to tax in the year 2020 because that is the year when stock is sold. So this is very important. You have to charge it to tax not in the year of conversion, but in the year when the stock is being sold. Sold means when it is actual sales of the stock is happening to a customer. That is the year you are going to charge it to tax under the head capital gains. Tax rate, whatever rate is applicable in the year where the stock has been sold, that is a tax rate you're going to apply. Next, we said that there is also income from head business or profession that is being generating from this particular type of transfer. So let us see. What is the business income that is being generated? Whatever is the actual sales value minus the fair market value as on the date of conversion will be your business income. Now, simple, let me make you all understand that when any capital asset is getting converted into stock in trade, now that stock in trade you're selling. So whatever is the actual sales value that you're collecting from the customer minus fair market value as on the date of conversion. If it is profit, it is going to be your business income. If it is positive, it is going to be your business income, profit, and if it is negative, it is going to be your business loss. So let us see a sum on this. So everyone has understood the provision relating to conversion of capital asset into stock in trade? Yes, students?
Yes, ma'am.
Okay, so before we start solving the problem, quickly, if any sum comes where you have to convert your capital asset into stock in trade, there will be always two types of income that is generated. Which are the two types of incomes that will be generated under which two heads of income?
Income from business and profession and income from capital gain.
Very good. How do you calculate income from business and profession under this particular type of problem if it comes? Whatever is your actual sales value minus the fair market value as on the date of conversion. Correct?
Yes, ma'am.
Okay. And what is going to be your sales consideration when you are going to calculate income from the head capital gains? Always
Yes.
sales. Yeah, tell me, students. It is going to be fair market value as on the date of conversion, and your cost of acquisition, cost of improvement and expenditure and transfer will be as usual. So keeping this provision in mind, let us quickly start solving the problem. Mr. A converts his capital asset acquired for an amount of 50,000 in June. So can anyone tell me what is this 50,000 acquired and for an amount of 50,000 in June 2003? What is this 50,000?
Cost of acquisition.
Cost of acquisition.
Very good. Now this 50,000, whatever he had acquired in 2003, he's converting it into stock in trade in which month? November 2016. So November 2016 becomes your year of conversion. Is this clear?
Yes, ma'am.
Okay. Now the fair market value of the asset on the date of conversion means on 2016 November, the fair market value of the asset was how much? 4,50,000. Okay. And the stock in trade was sold for an amount of 6,50,000 in the month of September 2019. What will be the tax treatment? And they have given you the cost inflation index of different years which will be required. Usually this will be given in every problem, but suppose if they have not given, they will provide you indexes. How they used to provide for FM, they will provide you with the index. Okay. Students, now quickly tell me, which year should I charge it to tax? In the year of conversion, should I charge tax, or should I charge it to tax in the year when the stock is sold?
When the stock is sold.
Okay, so stock is sold in September 2019, means it will be chargeable to tax in the assessment year 2020-2021. So let us start solving. The capital gains on the sale of capital asset converted to stock in trade is taxable in the given case that we have identified. It arises in the year of conversion, but is taxable in the year in which the stock in trade is sold. Arises means when conversion took place, already capital gain has arisen, but you will tax it only in the year when stock in trade is sold. So let us, and profits from business will also be taxable in the year when the stock is sold. That is common sense. So now let us see this computation. The long-term capital gains and business income for the assessment year 2020-2021 are calculated as under. So first let us calculate the profits and gains from business or profession. I told you, how do you calculate the profits and gains for business or profession in case there is a conversion of capital asset into stock in trade? You take the actual sales proceed of stock in trade. What is the actual sales value for which the stock was sold? It was 6,50,000. So taken 6,50,000 less cost of stock in trade, which is nothing but what you have to take, fair market value on the date of conversion. What is the fair market value as on the date of conversion? It is 4,50,000. So this becomes 2 lakh as your business income. Okay. Second, we know that there is a long-term capital gain also that arises. So here first we take sales consideration. Now sales consideration is nothing but fair market value on the date of conversion. What is the fair market value on the date of conversion? It is 4,50,000. Less expenses on transfer are not there. You get net sales consideration. Less indexed cost of acquisition. Now what is indexed cost of acquisition? As usual, we have seen that in the provision, index cost of acquisition is to be taken as usual. So index cost of acquisition will be available only, indexation is available only, students, till the year of conversion. Only till the year of conversion you're going to get the indexation benefit. So 50,000 is the cost of acquisition into index of the year of conversion. What is the index of the year of conversion? You're converting in November 16. So index of 16-17 is how much? 264 divided by the year of acquisition. When are you acquiring the particular, when is Mr. A acquiring the particular capital asset? In 2003. What is the index of the year 2003 for? It is 109. So 50,000 into index up to the year of conversion divided by the year of acquisition, index of the year of acquisition. When you solve this, you get 1,21,101. So when you deduct this both, the long-term capital gain is 3,28,899. You can write less index cost of improvement nil because nothing is mentioned, and then you can show the format. Now, and in the note you can tell that for the purpose of indexation, the cost inflation index of the year in which the asset is converted into stock in trade should be considered. Is this clear, students? Is this sum clear? Yes, ma'am. Okay, quickly we'll see sum on the same sum, conversion of capital asset into stock in trade, because let me tell you, this is very important provision. Okay, insurance claim is not that important. It may or may not be asked, but conversion of capital asset into stock in trade is most frequently asked. That is why I'm solving one more problem on this. Just you need to remember what are the terms that you need to take. That's it. Now let us quickly see this. Arav converts his plot of land purchased in July 2003 for 80,000 into stock in trade for 31st March 2018. Now tell me quickly, students, what is this 80,000? Arav converts his plot of land purchased in July 2003 for 80,000.
Ma'am, cost of conversion.
It is cost of conversion.
Acquisition, ma'am.
Cost of acquisition. Very good.
And cost of acquisition.
Very good. Which is the year of conversion? 31st March 2018. He is converting the land into stock in trade. The fair market value as on this date was 3 lakh rupees. The stock in trade was sold for 3,25,000. So 3,25,000 is the actual sales value. And when, in which year it was sold? It was sold in the month of January 2020. Find out the taxable income, if any, and if so, under which head of income for which assessment year. Now, obviously, it is sold in between in the previous year 1920. It will be chargeable into tax in the year 2021, correct? Assessment year. So they have given cost inflation index for 3 years. 3 and 4, the cost inflation index is 109, 1718, 272, 1920, 289. Use whichever is applicable. Okay. Now let us begin solving the problem. We know that whenever there is a conversion of capital asset into stock in trade, there are two types of incomes generating. One is income from the head capital gains, one is income from the head profits and gains from business or profession. So here, anyhow you can present it, students. First you can present profits and gains, and then you can present capital gains. No issues in that. So capital gains. How do you calculate capital gains? First you take sales consideration. Now what is the sales consideration when there is a conversion of capital asset into stock in trade? You always take fair market value as on the date of conversion. So the fair market value as on the date of conversion is 3 lakh. So you have taken 3 lakh. Less expenses on transfer, which is nil. Less index cost of acquisition, same as usual you have to take, but indexation will be available only up to the year of conversion and not up to the year when the stock is sold. So 80,000 is the cost of acquisition into the CII of which year? The year when the stock is being, when the capital asset is being converted. So it is converted in which year? 31st March 2018. So which previous year does it fall? 1718. So what is the CII of the year 1718? It is 272. So into 272 divided by year of acquisition. Year of acquisition is 2003. So what is CII of the year 2003? It is 109. So you have taken 80,000 into 272 divided by 109, which you have got it as 1,99,633. Less index cost of improvement, which is again nil. So what is the long-term capital gain? 1,03,367. Now let us see profits and gains from business or profession. We know that there is a simple formula to calculate profits and gains for business or profession when there is a conversion of capital asset into stock in trade. That is actual sales price of the stock in trade less fair market value as on the date of conversion. So what is the sales price of stock in trade? The stock in trade was sold for 3,25,000. So you have taken here 3,25,000 less fair market value on the date of conversion. So fair market value on the date of conversion is 3 lakh. So 3,25,000 minus 3 lakh. So the business income is how much? 25,000. So total taxable income is how much? When you add the incomes of all the 5 heads, you get total taxable income. So here 5 heads, no, here we have only 2 head income. So computation of taxable income of Mr. Arav for assessment year 2021. Profits and gains from business and profession is 25,000 and long-term capital gain is 1,03,67. So taxable income, when you add this both, you get 1,25,367. So students, have you all understood this particular sum?
Yes, ma'am.
Okay. Now, let us move to the next type of transfer, which is regarded as transfer. And if that particular problem arises in this particular situation, what are the different terms that we have to consider? So, capital gain on transfer of capital asset by a partner member to a firm AOP BOI as capital contribution. See, we have already studied that in partnership many times when new partner enters into the business, or when the existing partner is there in the business, and he will usually, give some asset. Usually, he'll give some capital contribution in the form of money, but many a times he may even transfer his personal capital asset into the business as his capital contribution. So this also is regarded as a transfer. So when any partner is transferring his capital asset into the business, into the firm, so this transaction is also regarded as transfer, and it is liable to capital gain tax. Okay. So we know capital gain tax means four things we have to know: sales consideration, cost of acquisition, cost of improvement, expenditure on transfer. So let us see what we have to consider. Where a partner or a member, whether existing or new, as I told you, either new partner is admitting or either the existing one, transfers any of its capital asset to the firm, AOP or BOI, of which he is a member by way of capital contribution, the same shall be treated as transfer. And if it is a transfer of a capital asset, we know that capital gain tax is liable. So let us see what is the tax treatment we are supposed to do. What is the sale consideration we are supposed to take? Sale consideration we have to take as the amount recorded in the books of account of the firm AOP BOI as the value of such asset. Remember, students, sales consideration, you have to not take the fair market value of the asset. Suppose I'm into a partnership and Mr. X is a new partner that I'm inviting, and he's getting a particular asset, and I'm recording in the books of the firm at suppose 2 lakh rupees, but the fair market value is 5 lakh. Then what is the sale consideration? I have to take only 2 lakh, because the provision says that take the sale consideration as the amount that you're recording in the books of account in relating to that asset that the partner is getting. So remember that when any partner is getting a capital asset into the firm, sale consideration will be the amount recorded in the books of accounts of the firm AOP BOI as the value of that particular asset. Next, cost of acquisition, cost of improvement, expenditure and transfer will be as usual, no change in that. Taxable, it will taxable in the year of transfer. When the partner is transferring his capital asset into the business, into the firm, that year you have to charge it to tax. Indexation benefit, as usual, that is indexation benefit will be applicable up to the date of transfer. That is our usual, normally what we do. Note, fair market value of such asset is irrelevant to decide sale consideration. In this particular provision, fair market value plays no role. What plays role is the amount at which that particular asset is recorded in the books. That amount is going to be your sales consideration. So let us see a problem on this particular provision. So students, capital gain on transfer of capital asset by a partner member to a firm AOP BOI way of capital contribution. So let us see a problem on that. ABC company has 3 partners, A, B, C, who share their profit and loss in the ratio 5:3:2. They admitted B as a new partner on 31/3/2019 for 1/5 share, and B is to bring 2 lakh rupees as his capital, which he brought in the form of furniture, which was earlier used at his home. 50,000 immediately and brought further jewelry of which fair market value was 2 lakh rupees on 2/4/2019. However, such asset was recorded in the books at 1,50,000. B had acquired such jewelry for 45,000 on 7/7/2001. Compute capital gains in the hand of Mr. D. Let me explain the problem if you have not understood. ABC were three partners. They were admitting a new partner, that is D, and D was to bring his capital. Now in entire capital of 2 lakh, okay, where furniture he was supposed to get worth rupees 50,000, which was his personal furniture, okay, and jewelry he was supposed to get worth rupees 1,50,000 was recorded in the books for the jewelry, and 2 lakh was the fair market value. Okay, and he had acquired that jewelry for 45,000. So the cost of acquisition of the jewelry is 45,000, and the jewelry was recorded in the books at 1,50,000. Fair market value of jewelry was 2 lakh. So they're telling compute capital gains. So by this problem, you all should be able to identify that this is a capital gain provision, where you have to see what is the it is a contribution by the partner into the firm. So tell me, students, for furniture, will it be liable to capital gain tax? If he's getting his personal furniture into the business, will it be liable to capital gain tax?
No, ma'am.
Because see here, capital gain on transfer of capital asset by a partner to the firm. Now, capital asset definition does see the solution. In the given case, Mr. D has two assets. Furniture being personal effect is not a capital asset and hence not liable to capital gain. Jewelry is falling under the definition of capital asset, hence liable to capital gain. So let us start solving. Sales consideration. Tell me, students, what is the sales consideration that you are supposed to take? Is it the amount that you're recording in the books at the time for that particular jewelry, or is it the fair market value of the jewelry you are supposed to take?
Amount recorded in the books.
So amount recorded in the books is 1,50,000. So you have taken sale consideration as 1,50,000. Less expenses on transfer. There are no expenses on transfer, nil. So net sale consideration is 1,50,000. Less indexed cost of acquisition. Now in this provision we have seen index cost of acquisition improvement will remain as usual. So what is index cost of acquisition? First is the cost of acquisition of the jewelry, which is 45,000. Okay. Into the CII of the year of transfer, because indexation also is normal up to the year of transfer you're getting. So CII of the year of transfer is 2019. He's transferring his capital asset into stock in trade. So we know that 1920, what is the CII? It is 289. Okay. Divided by CII of the year of acquisition. Now he's acquired it in the year 2001. And our index also starts from the year 2001. So the first index is always 100. This you all can see in the indexation chart. So 45,000 into 289 divided by 100, you get 1,30,050. So there is no cost of improvement, it is nil. So 1,50,000 minus 1,30,050, you get 19,950, which is your long-term capital gain. In the note, you can write that sales consideration shall be the amount what you're recording in the books of accounts of the firm, and market value of the asset is irrelevant, plays no role. So did everyone understand this particular problem and provision? Yes, students?
Yes, ma'am.
Okay. Now let us move ahead to the next type of transfer, which is regarded as transfer and what treatment it has to be given. Now suppose if there is a self-generated asset. Okay. Now if I say self-generated asset means which you have not purchased, you have created. Like it can be self-generated assets which are not purchased, like it can be a goodwill of a business. See, goodwill, you can also purchase it. But many a times people create their own goodwill. So that is called self-generated. That is, you have generated by yourself. It is goodwill of the business, you can say. Tenancy rights, you can say. Trademarks, brand name. Okay. Right to manufacture or produce some article or thing. Right to carry on any business or profession. So that is assets that you have generated by yourself. So what is the capital gains in case of self-generated assets? So again, we know that there is cost of acquisition. So suppose if you're acquiring such assets, suppose if you're acquiring the goodwill, okay, so it is going to be the purchase price, whatever price you're acquiring. But suppose if it is not in the cases being falling, this means if it is not a asset that you are acquiring or you're purchasing, you're self-generating it. So always remember, cost of acquisition of self-generated asset is always going to be nil, students. If I'm creating my own goodwill and when I'm selling my goodwill, so but when I've created my goodwill, did I incur any cost? No. So the cost of acquisition for creating my own goodwill for me will always be nil. So remember this, very, very important. The cost of acquisition of self-generated asset is always going to be nil. Okay. But if you have purchased it, it is going to be the purchase price. Okay. Next. Treatment of self-generated asset generated before 1/4/2001. So already we have done this in the provision where any asset that is acquired before 1/4/2001, you have to adopt the fair market value or the cost of acquisition, whichever is higher. But in this case, if aforesaid assets, aforesaid means which I told, goodwill of the business, tenancy rights, trademarks, brand names, okay, if those assets are developed or purchased before 1/4/2001, the option of adopting fair market value shall not be applicable, and even in such case, the cost of acquisition shall be computed as per above table. Above table means this, as per this, that it is going to be nil. Cost of improvement, in case of goodwill, right to manufacture, produce any article, thing on any business or profession, the cost of improvement shall always be nil. So remember, students, in case of self-generated assets, cost of acquisition, cost of improvement is going to be nil. If you're selling that asset, whatever sales value at which you're selling will be your sales consideration. But your cost of acquisition and cost of improvement is going to be nil. So let us start solving a problem on this, so that you understand the concept better. Capital gain in case of self-generated asset. Lisa transferred the following assets, determine the capital gain. So, land acquired in 1976. Okay. Students, tell me, land, is it a self-generated asset? Can you create your own land?
No, ma'am.
Okay, so if it is not a self-generated asset, means you cannot apply the provisions that we have seen now. Okay, so they have given the cost of the land is 25,000. The fair market value as on 1/4/2001 is 1 lakh, and the sales value is 30 lakh. Next asset is goodwill of the business. Business commenced on 1/5/1995. So where the cost is nil. When they're telling that the cost is nil, means it is a self-generated asset, correct? Goodwill. Fair market value is 40,000 and sales value is 2 lakh. Next, tenancy right also is a self-generated asset where the cost is nil, market value is 30,000 as on 1/4/2001, and sales value is 3 lakh. Goodwill of profession commenced on 1/5/1996 is again nil, 15,000 and 1 lakh 50,000. Remember when I told you all goodwill, I told you all goodwill of a business is a self-generated asset. Brokerage paid on transfer, whenever all these transfers are taking place, the brokerage that is being paid is 2%. On January 31st, 2020, Mr. A has transferred self-generated goodwill of his profession for a sale consideration of 70,000 and incurred 5,000 for such transfer. Okay, you are required to compute capital gains chargeable to tax in the hands of Mr. A for the assessment year 2020-2021. So let us start solving, students. First, we have taken land, goodwill, and tenancy rights. What is the sale consideration? For land, goodwill, and tenancy right, the sale consideration is 30 lakh, 2 lakh, and 3 lakh. Is this clear?
Yes,
Yes,
ma'am.
okay. Less expenses on transfer. We know that the brokerage is paid at the rate of 2%. So 2% of the above, you get 60,000, 4,000 and 6,000. So net sales consideration, you get it as 29 lakh 40,000, 1 lakh 96,000 and 2 lakh 94,000. Now, less index cost of acquisition, less index cost of improvement, only it will come in the case of land. Why? Because land is not a self-generated asset and land provisions we have seen is different. So what is going to be the index cost of acquisition in case of land? Land is acquired in 1976. So what is going to be the cost of acquisition for land? We have seen if any asset is purchased before 2001, so that is purchased in 1976, what is going to be the cost of acquisition? It is going to be the fair market value as on 2001 or the actual cost, whichever is higher. Now in 25,000 and 1 lakh, what is higher? 1 lakh. 1 lakh into CII of the year of transfer. When he's transferring in the year 31st January 2020, the transfer takes place. Here you can see, okay, transferred on 2/5/2019. So it comes in the year 1920. So it is 289 index of 1920 divided by CII of the year of 2001 2002, because indexation is starting from 2001. So it is 100. So when you solve this, you get index cost of acquisition as 2,89,000. Is this clear, students?
Yes, ma'am.
Okay. Now, what is going to be the index cost of acquisition for goodwill and tenancy right?
Ma'am, nil.
So you have taken it as nil. Okay. So you have got the long-term capital gain as 26 lakh 51,000 for land, for goodwill 1 lakh 96,000 and for tenancy right as 2 lakh 94,000. Is this clear, students?
Yes, ma'am.
Okay. So we have completed with the provision relating to capital gains in case of self-generated assets. See, whichever are important and frequently asked in the exam, I am solving the problems relating to that in connection with the provision, and the rest others which are not that important or don't fall in the exam, I will just give you the notes that what is the cost of acquisition you're supposed to take, what is the cost of improvement, what is the sales consideration. I will give you in the notes. You all can go through it. The next thing is capital gain on transfer by the way of compulsory acquisition. This also is very important. So let us see. Today, I think we'll be just able to see the provision. Some on this we will solve tomorrow in the next lecture. So what is the meaning of compulsory acquisition, students? Can anyone tell me? I've already explained this. What is the meaning of compulsory acquisition? See, when government is compulsorily acquiring your capital asset, suppose, as I've given you example, that when government wants to, expand, or the local authority wants to expand the roads, okay, it wants to largen the roads. So usually the buildings that are falling on the road master plan, what does the government do? The government gives some compensation to that particular house and tells them to vacate it, destroys it and expands the road. So they are compulsorily acquiring the capital asset of a particular SSC in return for a compensation. So they give a compensation to the SSC for compulsorily acquiring the capital asset. So tax treatment of initial compensation received. What is the sale consideration you're going to take? Total compensation that is you're going to receive from the government or from the local authority or from the tribunal, from the court. Whenever you're receiving the compensation amount, it is going to be your sale consideration. Your cost of acquisition, cost of improvement is going to be as usual. Expenditure on transfer will be your legal expenditure incurred to recover your claim, also will be regarded as expenditure on transfer. Many times government does delay in giving the compensation. They break the house, they expand the roads, but yet the SSC is liable to receive the compensation. So usually the SSE will go into some legal expenditures in order to recover the amount. So that also you can take under expenditure on transfer. And which year it is taxable? In the year when such compensation or part thereof is first received. Suppose you have to receive a compensation of 1 crore. First, if you have received 50,000, 50 lakhs, so the year you're receiving first part out of 1 crore, 50 lakhs you're receiving, that 50 lakhs you charge in 1 year. Later, 50 lakhs you charge it in the year that you're receiving. So even in part, if you're receiving, that part will be taxable in the year when your compensation is receiving. An indexation benefit is available till the year of compulsory acquisition. So the year up to which the government is compulsorily acquiring your property, that is called indexation benefit is available up to that year. So students, is this provision understood? We will be solving problem on this so that you'll better it will be better for you all to understand the provision. But did you all understand what is the sales consideration you are supposed to take? Students?
Yes, ma'am.
Okay, so problem on this we will be seeing in our next lecture.
Okay, ma'am.
Thank you so much, students.
Thank you, ma'am.